Hello everyone and welcome back to another episode. I'm your host, the Millennial Investor, and today we're going to be answering the question, are bonds a good investment in 2020? A lot of people ask me, are bonds a good idea to buy in 2020 with this recent recession that has hit us, or should I stick to stocks? I'm going to be going over some of the basics of bonds, if I'll be adding bonds to my portfolio, when I'll be adding them, and what are some of the things that I'll look for as far as bond investments go. I know on this channel this is the first time we've covered anything related to bonds, and I wanted to bring this up because in the last video we brought up the 5 reasons to be a dividend growth investor. So as you can see here, as we went over last video, the average investor generated an annualized return of 2.1% over the last 20 years, compared to 8.2% from stocks in the S&P 500 and compared to 5.3% from bonds, respectively. So when I was reading over that and I was trying to think of a video idea, I thought what a perfect time to go over this 5.3% that wasn't covered in this article. So as usual, if you like watching my content and you enjoy watching my videos and you're interested in using M1 Finance, make sure to use this link right here. It's in the description of all of my videos and you will each get $10 for being referred using my unique referral link. And I can put that $10 towards my dividend portfolio and you can get started in investing, and I'll make sure to mention you in a video. So before we get started with bonds, I wanted to show you an update on my portfolio as always. Some of the biggest gainers in the portfolio, Discover Financial Services had a huge day yesterday. Yesterday was a very big green day in the market. As you can see, we hit an all-time high yesterday, and then today's down a little bit. We hit over 50% up now on Discover Financial Services. We are completely overweight in the portfolio. You can see that jagged edge there on the circle. And Whirlpool and Cisco and Foot Locker are still some of the biggest gainers, but Discover Financial Services shot up. We are still up on all 30 stocks, and Procter & Gamble and Caterpillar are still lagging. I'm very much excited to keep on continually adding to Caterpillar, especially with the potential infrastructure bill that might be getting passed between now and the next couple months. But regardless, it doesn't matter if we're talking about Caterpillar, we're talking about Discover Financial Services, we're talking about Broadcom. All of these companies are very solid, well-paying dividend companies, so I'm honestly excited to buy any of them at any price. So let's jump right into the video. So with bonds. So first off, what we're going to do here, we're going to click research and we're going to click funds, and then we're going to click bonds right here. So that lowers it down to 420, and then we're going to go to domestic. I only want to mess with domestic bonds. I do not want to mess with any of these others right here. So foreign, I'm not really interested in any kind of foreign bonds. I don't know enough about them, and I honestly just flat out don't trust them. So that's not something I want to work with. Inverse debt and leverage debt, I think that is especially more of a risky play for bond investors. And honestly, if you're a bond investor, I don't understand why you would really mess with those, because the whole point of investing in a bond is to have a safe, steady, conservative approach to investing. So investing in leverage and inverse debt is more of a rather risky investment for bonds. So I would stay away from that. So we're going with bonds, we're going with domestic, and then here's the two that I wanted to point out here especially. Corporate versus government. They have other ones here, such as multi-assets and municipal bonds. They have two other choices here, but the two most common are corporate and government. Corporate debt is companies, such as like Tesla, for example. Tesla issued a bunch of bonds recently, about a year ago, to pay for a lot of their vehicle deliveries and stuff like that. And Carnival Cruise Lines. Carnival Cruise Lines, for example, they're having a lot of debt with this recent recession that has taken place, and they issued billions of dollars worth of bonds. That is corporate debt. Or what about junk bonds? What about Ford, for example, that is on the verge of bankruptcy, honestly? Those are bonds that I wouldn't want to mess with. So as I mentioned with inverse debt and leverage debt, I wouldn't want to mess with these risky bonds because, okay, let's take Ford, for example. Over the last 5 years, Ford has went down 67% almost. And they just reported earnings again the other day. They just cut their dividend because they couldn't afford to pay it. So if they cut their dividend and they're no longer able to pay their dividend, what's to say that it won't happen with their bonds as well? What's to say that they won't go, oh my gosh, we're not going to be able to pay those bonds, so you guys are stuck in the mud? I don't really like investing in corporate debt, even on the very high investment grade. Like, for example, one of the stocks that I own is Johnson & Johnson. They're one of the only two companies in the world, Johnson & Johnson and Microsoft being the other, that have a AAA credit rating, which is higher than that of the government. I mentioned that in a previous video. Johnson & Johnson has performed very well over the last 6 months or so. But Johnson & Johnson is a stock that I believe has very, very safe bond ratings, and even still, I don't like to personally mess with them. I don't really want to invest in a bond that is not from the government. I know this has to do with personal taste, but we're going to be looking at government. So already we have it lowered down to 40 different bond ETFs through M1 Finance. And then the last thing we're going to look at, this is the last thing to choose from, inflation protected, long-term, midterm, short-term. I want to show you the differences between these two. So basically the first choice here is inflation protected. Basically what this does, it's pretty self-explanatory. It follows along with the market and goes up at least 2% a year. So that way if you're really old, if you're retired, if you're 60, 70, 80 years old, and you're worried that you might outlive your retirement, these will go up at least 2%. 2% is about the average increase for inflation. These will go up at least 2% every single year, so you will at least match inflation, if not beat it. So that is the point of inflation protected. Those are not going to be the ones we're looking at today. So let's focus on these bottom three. Long-term, mid-term, short-term. What are the differences between these two? So the short-term are the very short-term bonds going from 1 month up to about a 1 or 2, 3 years. So these are bonds that I don't really want to mess with because I want to show the difference between a short-term, mid-term, and a long-term bond as far as their performance. So first off, generally speaking, the longer the bond, the better the interest rate, and the shorter the bond, the worse the interest rate. The reason being, the government wants you to be incentivized to purchase those 30-year long-term bonds. To do that, they have to offer better interest rates. So having your money tied up for 1 year is a lot better than having it tied up for 30 years. That said, they will pay you more for that. They will compensate you for that time that you're spending. So a short-term bond lasting as short as 1 month, lasting a couple years, is not an extremely long time for a bond, even though it sounds like a super long time. So let's just look at the first one here, SHY. It's iShares 1 to 3 year Treasury Bond ETF. iShares is also a bond ETF that we'll be looking at for long-term bonds, and it'll even be one of the ones that we'll potentially be buying. So if you see here, first off, if you look, it has a 1.95% dividend yield, an expense ratio that is pretty low. iShares have pretty good bond ETFs. If you look at the 5-year chart, in 5 years, this bond ETF has only went up 2% in price. Now, obviously, you would have received dividends in that time, and it is paid out monthly, but only going up 2% over the last 5 years is pretty minuscule. I mean, you're basically break even, and until about a month, 2 months ago, you would have been dead even. You see that dotted line here is right about break even. Other than your dividends, you would have little to no gains. So let's compare that to the S&P 500. So comparing that to stocks, over the last 5 years with this recent recession, stocks have went up 40.66% and currently have a dividend yield that is nearly identical to these 1 to 3 year treasury bonds. So you're getting 1.98% and 0.09, and let's compare that to where we were at, SHY. So 1.98 versus 1.95, so nearly identical. The stocks are actually higher right now, and the expense ratio is higher on the bond ETF as well. So it would be the better investment to invest in the S&P 500 for the long term, strictly for dividends and expense ratio. Forget share prices. But the share prices as well have went up over 40% more over the last 5 years in the S&P 500 compared to the bonds. Now that said, past performance does not reflect future performance. It does not guarantee anything. But that said, let's compare this to some of the midterm bonds. So I know that past performance does not guarantee anything and it does not reflect future performance. A stock that has went down 90% 1 year could double the next. You never know. And then vice versa. Stocks that have went roaring higher the last decade or so could come tumbling down in just a matter of a couple years. But that said, I'm sure that these bonds that are usually much more predictable in price than the average S&P 500 stock are going to have similar performances over the next 5 years. If we go back and let's just compare this to one other, so let's look at Charles Schwab, Vanguard. So Charles Schwab, as you can see right here, over the last 5 years, they performed about the same, 1.83%. Dividend yield is about the same, pretty similar expense ratio, a little bit lower. And the same thing goes pretty much across the board. Let's look at Spyder Etf. Spyder was also one that owns the SPY, S&P 500, 1.49%. As you can see here, you see a trend. They're usually right around 1-2%. A lot of these bond ETFs track each other pretty closely. So in 5 years, only getting 1 to 2% on your money, not factoring in the dividends, 1 to 2% on your money for 5 years, basically break even, I'm not interested in that. If I'm only going to get 2% a year every year, I would probably not be nearly as much into stock investing as I probably would be. Right now, if you go to my portfolio, so this is why I'm not having stocks in my portfolio right now. If you copy this into your web browser, So we just shared my pie and we copied this link into the web browser. When this pulls up, it's going to show my pie preview. Right now, as of yesterday's close, my portfolio yields 3.815%, nearly 4%, so almost double that compared to the bond ETF. The bond ETF that we just looked at was SPTS, which is the Spyder Etf. It yields almost 2%, but my portfolio yields almost 4%, so nearly double that of the bond ETF. So let's compare that to an example of the midterm bonds. So you'll see a trend here. As I said, these performed about 2% over the last 5 years. Let's compare these to midterms. These are usually bonds that usually last around typically 5, 10, 15 years, usually right around that gap, this range. So once again, let's scroll to the top here. There's 10 in the midterm. So let's just look once again. I'm going to pick this one because you can see the name right here. It's another iShares ETF, so it's owned by the same people, and it has about 8.9 billion assets under management, so it's one of the largest in the group. And you can see here it has a dividend yield that is right around 1.8%, so pretty close to that of the other bond ETF, but these performed a little better. I said the average with the other ones we looked at were about 2%. These have went up about 7.6%. 7% is not anything to write home about, but it is something, and this expense ratio is the same. Comparing that once again to the S&P 500, the S&P 500 went up 40%. Same dividend yield that's even a little bit higher, and it went up 40% compared to these midterms that only went up 7%. Here, so let's just pick this one. Let's look at Vanguard ETF. Vanguard, by the way, are some of the best performing ETFs, just generally speaking. It doesn't matter if we're talking about stocks. It doesn't matter if we're talking about bonds. Vanguard usually has very, very good performing ETFs, and they usually have very, very low expense ratios. This usually follows suit right here, something that is less than 0.1%. So this is 0.05% expense ratio. That is almost nothing. And they usually have very good dividend yields as well. So this is about in line with what we've seen. But over the last 5 years, this follows suit with the iShares 3 to 7 that we just saw as well. About 7-8%, and the short term we're only performing about 2%. So let's look at the last one, and these are the ones I want to focus here. And if I were to add bonds to my portfolio, this is what I want to look at. So there's 8 to choose from here, and these are the long-term bonds. These are the ones that are typically 20 years plus. Some of these are kind of midterm, like this one, for example. I don't know why it says long-term in the 7 to 10. I consider long-term bonds pretty much like this one says, 20-year plus. I want the 20 and 30-year bonds for my bonds in my portfolio. So let's just look at this one. This is once again another iShares 20-year Treasury bond ETF. The dividend yield is a little bit under 2%, so typically what we've seen from the other iShares bond ETFs, and the expense ratios are all the same, 0.15%. And over the last 5 years, these 20 and 30-year bonds have went up 34% in 5 years. And their dividend yields and expense ratios are nearly identical to that of the other bond ETFs. So here's my thinking in this. Not only in this recession, but other recessions as well, when a lot of large Wall Street investors get really scared and really worried about the market, the first thing that they do, they immediately flood money out of stocks and flood them to bonds. So let's look at the SPY. So the decline in stocks started right here around mid-late February, February 19th, February 20th, and then it was just a straight line down for about a month and a half. So let's compare that to bonds. So if we type in the search here, we are on TLT, that's the iShares 20-year bond ETF, and over the last 5 years, as you can see here, let's go to the February, right around December, January, this started a steady climb, and then when the stock market started to drop, which I said was about February 19th, February 20th, this was $145. And not only has this not went down, this has went significantly higher. It's went from 145, then to the 150s, the 160s, the 170s, and it has continually went higher. Those Wall Street investors that move the stocks, it's not the retail investors like you and me that move $100, $1,000, $50,000. Those aren't what moves stock prices. It's those large Wall Street investors that have hundreds of millions, billions of dollars in assets under management and move in and out of stocks. So this 34% is actually nearly right in line with the S&P 500, except when the recession hit, this does what it always does. People flood out of stocks and start flooding into bonds. Now on the flip side, as you can see over the last 5 years, until the last year or so, this bond ETF has stayed pretty much flat. It would have received dividends, it would have went up, it would have went down, But until this moment right here, about the middle of 2019, it has pretty much just went in a straight line. It's traded sideways. It hasn't went anywhere. You would have received those dividends every single month, but for the most part, your gains would have been nothing. So bonds are best for a recession type scenario. So we'll compare this to another long-term bond ETF just to make sure that we're having a reliable result and comparing this to some others. Again, like what I said, I picked this one. This is more than likely the one that I would be choosing if I were to be adding bonds to my portfolio for a couple of reasons. First off, like I said, Vanguard is A1 on their bond ETF and just ETFs in general. That expense ratio is so astronomically low. 0.07% is so minuscule that it's not really going to affect your returns whatsoever. And this dividend yield is quite a bit higher than that of the other portfolios. I would say there's really only one negative to this, is that this does pay out quarterly compared to some of the other ones we looked at. A lot of them do pay monthly, and especially when it comes to the last quarter of the year, they usually do have a bigger payment than usual, like here 211 compared to like 84 cents. But quarterly is fine as long as I'm getting dividends for holding my stocks and holding my bonds. I don't really care if it's monthly or quarterly. I would prefer monthly, but as long as I'm getting some kind of dividend payment, at least quarterly, then I'll be fine. But as you see here, not only is its dividend yield better, its expense ratio is better, but its performance is nearly exactly that of the S&P 500. So 41.02% has been the last 5-year performance, and the 5-year performance is 40.66 for the SPY. This is literally beating the S&P 500 over the last 5 years. So 40.66, and this is 41. If you would have invested in this 5 years ago and then had the S&P 500 5 years ago, you would actually nearly be tied and actually be beating the market by a little bit. As I mentioned earlier, past performance does not reflect future performance. This bond ETF might not perform that well over the next 5 years, and I don't expect it to. So let's look at buying stocks versus buying bonds in this moment. So here's why I'm not adding bonds right now. As you can see, over the last 5 years, it went up 40+%, and in the last year, it's up nearly 50%. A year ago, this bond ETF was $116, and now it's trading at about $170. 170 is significantly higher than that at the 120s. If this was at 120, 130, I would definitely considering adding it. But now that a recession has hit, all of these bonds appreciating in price is already priced in. I assume over the next 1, 2, 3 years, the return on this will probably be flat or maybe even negative. I don't think bonds have a whole lot of upside potential here because they're already priced in. And the same thing goes for stocks, with stocks recently dropping. Now I know that they have started to recover some, but even if you compare this, so the Spyder Etf of the S&P 500 was $340-ish, right below it. Even today, it is still trading under 300. So we're still trading at a 10, 15, 20% discount than what we were just 6 months ago. So this stock for the S&P 500 is still attractive to me because we know in the long run, here's the 5-year chart. We know that stocks in the long run, the S&P 500 in the long run will always go up. It'll just be a steady incremental line up. I know it will have its dips, like here in 2018. It dips and then it recovers. People get really worried about a trade war and then it recovers. If we get to 2020, there's a big spike down. Everybody's worried about the recession and then we're starting to recover already. Now we may retreat back here. We may be going a straight line up and hit new highs in the next month. I don't know. I don't care. But the point is the upside for stocks are always up with its major drops down. Bonds are more of a steady, safe, reliable return. So looking at bonds now with their very little upside potential, I will not be adding them to my portfolio. If we get 1, 2 years out and we have beaten this recession and stock market starts to hit all-time highs, I will be adding bonds to my portfolio. So just to give you an idea of what that might look like, I'll just give you an example. So this is my dividend growth portfolio. Something what I would do, I would lower this down in increments. So let's say, for example, we were a year out for the recession and I decided that, okay, it's time to add some bonds. Bond prices have come down, stock prices have gone up. What are we going to do to start preparing for the next recession? So let's say we're talking about 1 year, 2 years out. Let's add 5% in bonds, and then we'll lower this down to 95%. We'll add just one little chunk of bonds here, so if there is a recession, we can protect ourselves against that massive crash. And let's say another 6 months, another year goes by, then we're going to up this to about 10%. and we're going to lower this down to 90%. But if we get to a scenario like it was in 2019, 2020, where we go a decade plus without any type of major crash or major recession, it depends, of course, on what the market is doing and what prices look like. But if we keep on going in a continual lineup for a decade straight, I don't think we'll see that in 2030, where we'll see 10 years out where the stock market has went up every single year. It is very unrealistic. But the longer we go in the bull market, the larger this number goes up. And the more we go towards a recession, the more aggressive I get with the stock market. People always tell you that when you're young, you should have little to no bonds, but I don't think it really matters whether or not you're 20 years old or you're 65 years old. You should just play the market accordingly. What my MO, what my advice is for the stock market, just in general, whether we're talking about stocks or bonds, when you see the stock market like it is now and it's at a dip, it's at a discount, just like it was in 2018, if you would have got to 2018 and you would have panic sold everything towards the end of 2018 when everything dropped about 15, 18%, you would have looked like a fool. Stocks would have immediately went up, and bonds you would have been buying at a much higher price than what you would have just 3-4 months ago. So the same thing goes here for 2020. While stocks are at a discount, while we are starting to recover, focus more on stocks rather than bonds. Be more aggressive the stock market falls. At these moments right here, where we're looking where it's at an absolute bottom, where we're down 30+%, this is when you should be most aggressive. This is when you should be buying tons of stocks. And at these moments here where it's a straight line up, you should be more conservative. You should be adding more bonds. That doesn't mean you shouldn't be flooding away from stocks. That doesn't mean you should be selling everything. But you should get more and more conservative the longer we go. When you see these straight lines up, be conservative, 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 conservative. Be aggressive at these big drops right here. It recovers, be conservative, switch a little bit more conservative, conservative, and then major drop, absolutely get relentless with your stock purchasing. Even consider selling all or most of your bonds. What I will do is I will continually buy bonds until we see a massive drop in the stock market, and the moments where this EDV bond ETFs, when it skyrockets, I will take my profits and then I'll invest that in stocks that have significantly better valuations and better dividend yields than better than 2.65. Like I said, mine yields about 3.815, so I could get a better dividend than that, and I'll also get massive share price gains from this bond ETF, and then I'll flip the script and I'll go straight to stocks. So pretty much that wraps it up for bonds. If you have any questions, make sure to leave them down in the comments. As usual, if you like watching my videos and you enjoy my content and you would like to use M1 Finance yourself, use this link down below in the description. I really appreciate a lot of the comments that you guys have been getting. Some of you guys have been asking me about your portfolios, advice for what you would like to add. This is a basic, very simple example looking at bonds and some of the things you can look for. And I think you just really need to take it moment by moment, day by day in the market, because things always change. And this advice that I'm giving today could very well change in 6 months from now. And you might need to be flooding the bonds, or you might need to be buying stocks relentlessly. There's no one that really knows. So thank you guys so much for watching. Make sure to comment down below what you thought about the video, and I'll see you next time.